Okay, so group reporting. We are told here the draft statements of financial position of P company, S company, and SS company on 30th June 20x7 were as follows. So we have assets, etc. We are told the P company acquired its shares in S company on 1st July 2014. And then S company acquired its shares in SS company on 1st July 2015, where the reserves stood at that. It is the group's policy to measure the non-controlling interest at acquisition at its proportionate share of the fair value of the subsidiaries what year net assets. Ladies and gentlemen, remember NCI. We could either give NCI the proportionate share of the subsidiaries net assets, or we value their interest at fair value. At fair value, we look at both cases and then we compare and see what that really means. So prepare a draft consolidated statement of financial position of P as at this. Assume no impairment of goodwill. So ladies and gentlemen, step number 1, remember there are 6 or 7, say 7 basic steps. Basic steps when you are doing a consolidation question, we have actually there are 6 basic steps. So step number 1 is the group structure. Step number 1 is the group structure. Step number 1 is the group structure. So you have to ascertain the group structure. We have to ascertain the group structure. This is very important. The group structure, we must ascertain the group structure. So ladies and gentlemen, the group structure, how will this look like? The group structure, how will this look like? So we have P company that acquired S. S went ahead in this case here to acquire some other company. Great. So then give me the shareholdings. We are told in this question, ladies and gentlemen, in this question, this is what they have told us. Look at the investments. Investments at cost. You can see the parent company 120,000. It has 80,000 shares in S company. P has 80,000 shares in S company. Quite a nice thing. 80,000 in S company. So P has 80,000 shares of S company. So 80,000 out of how many? How many shares does S company have? S company, if you look at here, ordinary shares of $1 each, you can see the share capital of S company is 100,000. So I want to get the number of ordinary shares of S company. How do we get the number of ordinary shares of any company? You take the share capital, you divide by the par value. Share capital, you divide by the par value. So 100,000, fortunately, we were given a par value of 1. So 100,000 divided by 1. 100,000 divided by 1, this gives us 100,000. 100,000. So, ladies and gentlemen, this translates to what percentage of share ownership? 80%. 80%. Look at the next holding. We are told that this company called S happens to be having 60,000 shares in SS. You can see here there is a dash. We have S. S investment is worth 110,000. And this 110,000 that they paid were able to give it 60,000 shares in SS. So come and give us 60,000 shares in SS. Divide this by the number of shares that SS has in total. SS, you can see the share capital of SS is here, 100,000. Divided by the par value, that gives me 100,000. 100,000. So times 100, this will end up giving us what here? 60%. This will end up giving us 60%. Ladies and gentlemen, while you are evaluating your group structure, you must know, according to IFRS 3, in terms of influence and control, things have really changed. You can very easily get a situation where we have this kind of a big shareholding, 80%. But if we have decided to give our control to a different party, for example, you have decided and said that the NCI, you guys have got managerial experience. You've got managerial experience. And because of your managerial experience, we are going to give you this company. You run it without our interference. We even sign it without our interference at all for the next, say, 10 years. So meaning that we have given away our powers of control. When you give away your powers of control, ladies and gentlemen, then this cannot be termed as a subsidiary. You can't consolidate its performance in your group results. You can't do that. So remember, at times you could get even a situation where you have like 40% shareholding, 40% shareholding. But if the examiner shows you some hints somewhere, which, for example, says that you've got control powers, controlling policies of the company, being able to appoint, for example, 8 out of 10 directors of a company, even if your shareholding is quite little and you have the powers of sending decision makers to a company like that, then that company is yours. That is your subsidiary, and therefore you need to consolidate. Ladies and gentlemen, remember nowadays in terms of you giving us the subsidiary associate status, it's not really about the quantitatives per se. No, we have to look at the quantitative and the qualitative aspects as per IFRS 3. Here, fortunately, there is nothing in this case here that shows us that this is not a subsidiary. So we have here, of course, this is more than 50%. And in the absence, this is more than 50%. And in the absence of information that tells us that, fine, you guys have got this high percentage, but you are not controllers. Here, there is no qualitative information. So what are we able to see? We are able to see straight away that S is a subsidiary of P. S is a subsidiary of P. Is a subsidiary of P. And on the same breath, we are able to see that SS is a subsidiary. SS is a subsidiary of S. SS is a subsidiary of S. Ladies and gentlemen, because we are controlling S, because S is our subsidiary, and the S went ahead to acquire another firm that has turned out to be its subsidiary, then automatically SS becomes a company that is being controlled by the parent as well, regardless of our effective shareholding. Listen, we are saying that we control S, and the S controls SS. So if we control S, perhaps in this case here, we have sent all the directors of SS to run its board, to run the company. And the SS automatically, even if we only had a very small percentage of these, S, of course, will also have an impact automatically because of the control aspect on SS. So you're saying very importantly that therefore SS is also a subsidiary, of the P group, a subsidiary of P. My pens are letting me down, but we just have to fight with it. Okay. So we are saying that SS is also a subsidiary of P. Now listen, if SS is a subsidiary of P, first of all, even before I go to that, we've said here that S is a subsidiary of P. If it's a subsidiary of P, in this case here, then the P group commands what percentage? 80%, right? And then, of course, the balance will be handled by NCI, The balance NCI is what percentage? 20%. Now come to this other one that you have said is also a subsidiary of P group. So the P group here, ladies and gentlemen, this is quite easy. Consolidation, I should be able to get all the marks. Very easy. So the P group, ladies and gentlemen, the P group here, the P group in SS, controls what percentage? It is 80% times 60%, which will give me 48%. So somebody who doesn't understand this thing very well will tell you that SS is supposed to be an associate of P. No. Ladies and gentlemen, remember S is fully controlled by P. If that is the case and S is controlling SS, automatically SS becomes our subsidiary, So P group in SS has 48%. And therefore, NCI non-controlling interest in SS will be what percentage? 52%, which automatically now will end up giving me 100%. That is step number 1. Is there any question? Is there any question there? Any question? Any question? Step number 1 is the group structure. Group structure. Thank you very much. Group structure. That is okay. I'm trying to work on my pen. Don't worry. I'll be getting better pens. So group structure, that is okay. Now we've been able to ascertain that the 2 companies that we have as P group are what here are our subsidiaries. Step number 2, the financial statements. Don't go to goodwill. No. Step number 2, go to the financial statements. So tell us they are consolidated financial statements. Consolidated financial statements, that is what here, our second step. That is our second step. That's our second step. That's our second step, consolidated financial statements. Why should we go for the financial statements before we do the goodwill ETs? Ladies and gentlemen, remember, when you are consolidating, when you are putting things together, at the end of the day, there will be quite easy marks you're going to get for free without any workings. There will be things like, for example, we know that while consolidating the share capital, we only take the share capital of the parent. That is a mark which you'll be getting for free. Because I've always seen students who go to the group retained earnings working, goodwill. At the end of the day, they don't write what the examiner marks. Remember nowadays, the examiner in terms of group reporting, the examiner is so much concerned with what you're putting in the group financial statements. So come and give us here group financial statements. Group financial statements. So step number 2. Step number 2 is the group financial statements. And now basically I'll talk of the P group. My company is called the P group. And the financial statement that they want us to give them, is the consolidated statement of financial position. So P group, consolidated statement of financial position. Consolidated statement of financial position. So ladies and gentlemen, what I will do is simply to come and copy everything that I have here. So I start with assets. The first assets there are non-current assets. So we have non-current. I'm simply copying the table the way it is given. So we have the non-current assets. So non-current assets, what do I have there? I have the property, plant, and equipment, also known as the tangible assets. So we have the tangible assets. So we have here tangible assets. So we have the tangible assets, tangible assets, the PPE basically, Now, ladies and gentlemen, because now we have got a power of controlling these 2 entities, when it comes to PPE, what do we do? Everything is ours, the economic entity model. This is our economic entity. So we consolidate 100% line by line. We are adding. So in this case here, the parent has 105. The parent has 105 plus the first subsidiary there has got 125. The first subsidiary, the second subsidiary has got 180. So plus 180. Don't say equals. Later on, we'll be doing adjustments. Later on, we shall be doing adjustments. But if the push comes to the shove, if in this case here we have the examiner ringing the bell, telling you straight away that you have got 5 minutes, what do? You simply get your calculator and add. You'll be surprised if you go that way, you will end up getting about 8 of the marks. 8 marks out of say 20 without knowing any consolidation at all. So we are moving on. The next one, I can see so many comments here. Yes, great. Don't add, chapter, don't add. Okay. You know, later on, ladies and gentlemen, like now under non-current assets, later on in the notes, you'll be told, for example, that we have what we call the fair value adjustment. During acquisition, at times you have to value the assets. So if there was any fair value adjustment or a revaluation, the revaluation, of course, will come and add it here. And of course, anytime you revalue a subsidiary at the time of acquisition, chances are this revaluation surplus has not been depreciated. So PPE, the way I was taught those old days, I know for PPE, I'll have to leave it like this. And then later on, I'll be adding any revaluation minus depreciation on what year? On revaluation minus depreciation on revaluation. So you leave it like that. Don't take your calculator. Right now, we don't want calculators. We are only consolidating, putting things together. Consolidation is all about putting things together. The moment you have ascertained group status, the group structure. But remember, if you have got an associate, if you have got a joint venture, you don't consolidate line by line. No. If it's a joint venture or an associate, it's equity accounting, one line. I'll be showing you later on how to do that. For now, we are lucky because all the companies that we have are subsidiaries. Okay, thank you very much. Now, ladies and gentlemen, here we are. We are told here, not told, but go to the next. The next thing they are telling us, ladies and gentlemen, is about investments. Which investments are these? Investment in S. S is our subsidiary. S, ladies and gentlemen, is our serious relative. So in terms of the economic entity, in terms of the group family, there is no way we can ever say that we have invested in our own assets. We have invested in ourselves. It's not possible for you to invest in yourself. It's not possible for you to have internal investment. This is an internal company. It's a serious relative. Just how, for example, if I was to give, for example, my madam some money here and there, then, for example, she does ABCD. I don't really say that I've been, no. From the family perspective, this is just money which has moved from one person here, from one pocket. Just like how I can get money from here, I put it on the other pocket like that. So any internal investments, I can never recognize them. If it was investment in an associate, that is okay. Because an associate is a distant cousin, Just like in business, let me be very frank with you. If, for example, you are doing business, for example, I'm doing business. I'm selling, for example, ladies' clothes. And then my madam comes and tells me, I want this particular cloth. Will I sell this cloth to that lady? Or I'll give her free of charge? Somebody talk to me. I want to show you these internal arrangements. Will I give her the cloth for free? Or in this case, that dress for free? Or in this case, I will charge her. Let me read the comments here. Internal arrangements, ladies and gentlemen, must always be eliminated. Internal arrangements, ladies and gentlemen, must always be eliminated from we must leave them out. We must leave them out. So in this case here, of course, free, isn't it? At the end of the day, she's mine. Give for free. That is the thing, yes. That is the thing. The same thing with this company. This company is yours. So anytime you hear of investments in your company, those are not genuine investments. So ladies and gentlemen, what we have here, instead of these investments in your subsidiaries, you're going to have one line that will replace that, which is called what here? Goodwill. Remember, ladies and gentlemen, when you invest in your subsidiary, you're going to acquire some net assets. Perhaps the net assets of the subsidiary you've invested in is 100, right? The net assets of the subsidiary you've acquired is 100. But if you pay like 110, that 10 extra is something that will go to external parties. The extra, the premium, must always be captured in here. The premium cannot cancel with the equity, no. So goodwill, leave this as your working three. This will be your working three. Don't put any figure there. Goodwill is your working three. Now, from ladies and gentlemen, the next item here is current assets. Current assets. Could you kindly see the current assets that we have? The current assets that we have, I can see 80, 70, and 60 and consolidate them. So we have here 80 plus 100 plus 100 plus 100 plus 100 plus 100. Don't get out your calculator. So that is it. I'll come and give them a line here for total assets. For total assets, a line for total assets, of which I'll straight away go to the financed by side in the balance sheet, where I can see we have equity and liabilities. And normally we begin with equity. We begin with equity. Equity. So equity, I have ordinary shares. So we have here equity. We have here equity. Under equity, we have ordinary share capital. Ordinary share capital, we only take the parent's capital. The parent's capital. Ordinary share capital, we normally work with the parent's capital. So the parent's capital, what are you able to see? The parent is here. The parent share capital is 80,000. Parent share capital, so here I hope you have written in brackets, the parent share capital, parent share capital. This is a free mark. The parent share capital is 80. Parent share capital is 80. So this one, if you have the blast, of course yours is much organized. The parent share capital is 80. We don't bring the subsidiary share capital. These are the things which are cancelling with, my investment in the subsidiaries. So don't even try to understand so much right now for the sake of your exams which are starting next week. Ladies and gentlemen, know that for share capital, we always work with which share capital? Share capital of the parent. Share capital of the parent. From there, ladies and gentlemen, I can see retained earnings. Retained earnings, mentioned there, retained earnings. Retained earnings. Retained earnings. Retained earnings. Retained earnings, you can't consolidate them directly. Retained earnings, you need a working. Retained earnings, we need a working. Retained earnings, just write working in brackets. Retained earnings, you write workings in bracket. And then, ladies and gentlemen, remember there is something very important here. There is something very important. Other than these retained earnings, we have another equity component. We have the NCI. The NCIs will be our partners in the business. They are putting in money that they are not coming to demand from us. It's not a loan. It's a capital element. So NCI has to fall under equity, long-term source of owners' funds. Remember, NCI are also our partners. They're our partners. So after retained earnings here, as I look for a better pen, for retained earnings here, I want you to come under retained earnings, I want you to come and mention there the non-controlling interest. Non-controlling interest, and then you don't put anything there. Just write in brackets what here? Working. In bracket, put working there. In bracket, put working there. Now, ladies and gentlemen, we are through with the equity. If you are through with the equity, now we look at the liabilities. The liabilities, what are you able to see here? Liabilities, you can see we have payables. Payables, you write them the way they are. You consolidate them. You put them together. So payables, what do we have? We have 30,000, 35,000, 25,000. So in this case here, payables, we don't have any non-current liabilities. I can see payables. I can see payables here. I can see payables here. I can see payables. I can see payables. I can see payables. Payables. I know my pens are not very nice. They're really letting me down, but we shall overcome. We shall overcome. So under payables, I can see. Under payables, I can see. Under payables. Under payables, what am I able to see? I can see, ladies and gentlemen, I have 30. I have 30 here. I have 35. I have 25. Please don't get out your calculator. Because, of course, as you and I appreciate, at the end of the day, you'll be told that there are intra-owings. Intra-owings, as we've discussed, these family arrangements, ladies and gentlemen, family arrangements, any intra-owing has to be cancelled out. Intra-owings have to be cancelled out. They have to be cancelled out. So don't pick your calculator so far here. No. You live like that. Live like that. Ladies and gentlemen, down here you write what here? Total equity and liabilities. Down there you write total equity and liabilities. Total equity and liabilities. Total equity and liabilities. And then you live like that. So step number one, we've said group structure. Step number two, give us the consolidated financial statements. Here we don't have an income statement, so we Can't do it here. So go to step number 3. I said step number 3, sorry, I said it was goodwill. Step number 3 is supposed to be net assets of the subsidiaries. So right there, net assets of the subsidiaries, and then you have to give me a minute. I try getting a better pen. I even got it much earlier than I thought. Okay. So go to the third step, which is the step of what here? Net assets. Step of net assets. Step of net assets. Ladies and gentlemen, never do T accounts for consolidation. Never. Never do T accounts for consolidation. They really waste your time. Right? So for me, because my board is very small, I have to rub this. I know you guys will be able to fix the figures. Like that. So come and they give us the net assets. Net assets. So net assets. So the net assets of subsidiaries. Step number 3, working 3. Net assets of subsidiaries. Net assets of subsidiaries. So remember, we have the first subsidiary, and then we have the second subsidiary, SS. So remember, you have to give us the subsidiaries at year end, for each one of them year end, and at acquisition. At acquisition. At year end, and at acquisition. At acquisition. Please write like that. The same for SS. At year end, and at acquisition, like that. Okay. So ladies and gentlemen, please don't forget your accounting equation. Your accounting equation, we normally say assets. Assets equals who? Assets equals who, somebody? Assets accounting equation. Assets equals equity plus what here? Equity plus liabilities. Equity plus liabilities. Very important for you to know that. Could you kindly take this to the other side? If I take this to the other side, I'll be talking of assets minus liabilities equals equity. Equals equity. And then if you remember, even in financial management, assets minus liabilities is what we call net assets. This side. This is what we call the net assets here. Net assets. Meaning that in consolidation, we shall always be measuring our net assets using equity. I'm repeating again, for consolidation, our net assets of our subsidiaries will always be measured using equity. Using equity. So here we are. So equity, we start with share capital. So basically, we are looking at the equity elements here. Equity elements. So we have here the share capital. We have the share capital. We have the share capital. So please give me the share capital of S, the first subsidiary. S, the first subsidiary. Somebody, let us now work together. Now I have a better pen. I've got no reason to worry. What is the share capital of S company? At year end, remember year end is the reporting date. The one in the financial statements. The one in the financial statements. The one in the financial statements. Yeah. So at year end, the share capital, equity share capital of S is 100,000. So for S here at year end is 100,000. And then we have SS at year end is 100,000 as well. SS at year end is 100,000 as well. Right? The next item, of course, of equity, you can see they are normally paraded here. They are normally paraded here. The next item is retained earnings. So give us the retained earnings. Give us the retained earnings. So retained earnings, ladies and gentlemen, at year end, at the date of reporting, as per the balance sheet, retained earnings for S company is 170,000. Ningewachana hizi maziro tatu oye. Tuachana hizo maziro mingi mingi. So retained earnings at year end is 170 here, and then on the other side is 115 like that. Now, ladies and gentlemen, listen. In terms of net assets, if you can remember very well, the other thing that normally constitutes our net assets will be the revaluations at acquisition. The fair value movement at acquisition normally will go to the reserves. And if it's going to the reserves, it makes a very good component of what here? Equity. But in this question that we have is a simple model. It doesn't have any revaluations. So that is it. So come and give us these figures at acquisition and at year end. Listen here. So we are told, ladies and gentlemen, if you look at this very keenly, they are telling us P company acquired its shares in S company on 1st July 20 whatever, when the reserves of S company stood at how much here? Stood at 40. So those reserves, if I'm the one handling this, I'll put them under retained earnings at acquisition. Retained earnings at acquisition, we are being told, ladies and gentlemen, look at where I'm writing this. Retained earnings at acquisition. Retained earnings at acquisition. They're giving me what figure for S? It's 40. How about retained earnings at acquisition for SS? Retained earnings at acquisition for SS, what do we have? We are told S company acquired this when the reserves were what here? 50. So at acquisition, 50. Retained earnings at acquisition, 50. Now listen. This is something if you pick, you'll have picked it very fast. Ladies and gentlemen, when it comes to the share capital of the subsidiaries, it doesn't keep on fluctuating. I've never seen a question where they tell us that you have acquired a subsidiary and thereafter the subsidiary issued new shares. Nothing like that. So when it comes to share capital, at the year end and at acquisition, this share capital must be the same. For S, it will be 100. Ladies and gentlemen, how about share capital of SS? It's 100. So at acquisition, it must also have been 100 like that. And because you don't have any fair value adjustments, please come and give us these equity components. So give us the equity component of S at the year end. This gives me 270. At acquisition, this gives me 100 what year? 140. Come here, SS. At year end, what do we have? 200 what year? 15. This is 100 what year? Somebody? 150. Now, ladies and gentlemen, listen. Come here and give us the growth. The growth is what we call the post-acquisition profits. Post-acquisition profit. The growth in your equity is what we call the post-acquisition profit. So come here and give us post-acquisition profit. Post-acquisition profit, basically this is net assets at year end minus net assets at acquisition. Post-acquisition profit. So ladies and gentlemen, come and give us the post-acquisition profit of S. The post-acquisition profit of S. So S alone at year end, 270. Minus in this case here at acquisition, S, 140. So then what is the post-acquisition profit? Somebody give me this figure. What is the post-acquisition profit? Somebody give me this figure. What is the post-acquisition profit? Somebody give me this figure. Post-acquisition profit, 270 minus 140. That's for S. Somebody is giving me 130. 130. How about post-acquisition profit for SS? What do we have? For SS I can see 215 minus 150. 215 minus 150. This will end up giving us what figure? 215 minus 150 gives me 65. Now listen. This 130, of course, we know it has to be shared to the two partners. We have the P group. The P group. SSP group was 80%. P group will take 80% of the 130, and then we have the NCI. The NCI which will be taking 20%. NCI will be taking 20%. And then, ladies and gentlemen, the same with this 65. This 65, we have the P group. The P group, we have defined our percentages. P group was 48%, and then we have the NCI, which was 52%. NCI was 52%. So could you kindly give me this figure so that when we go along, we know what we shall be putting where? So what is 80% of 130? What is 80% of 130? 80% of 130 will give me what figure? I'm being given a figure of 104. 104. So we have here 104. How about 20% of 130? 20% of 130 is 26. Thank you. Come here, 65, 48%. 48%, 65. 48%, 65. 31.2. 31.2. 52% of 65. 52% of 65. We're almost finishing. I told you there are very few workings. Consolidation has got very few workings. What is 52% of 65? So I'm being given 33 point what here? 33.8. That is it. That is the end of that particular working. That is the end of that particular working. The next working after I get net assets, the next working will be the goodwill. Goodwill. So mention there, goodwill. Goodwill. The students who came in a little bit late, unfortunately, you'll have to float kidogo tu like utakamata saizi, don't worry. So come and give us a working for goodwill. So a working for goodwill. A working for goodwill. So goodwill, we have in this case here the consideration. The consideration paid by P group. By P group to acquire S and to acquire SS. The consideration that was paid by P group to acquire S and to acquire SS. P group, remember. P group, remember. Ladies and gentlemen, P group paid how much? Look at the investments here. If you look at the investment for P to acquire S, they paid 120. If you're together, you can see P paid how much here? Paid 120 to acquire S. And then you can see we have 110 was paid by S to acquire SS. So then P paid how much? P must have paid 80% of that 110. P paid only 80% of the 110. Remember the 110 was paid by who? Let us be clear on this. Let's be clear on this. Ladies and gentlemen, let's be clear on this. Who paid? I would want us to be very clear on this. Who paid, ladies and gentlemen, who paid this 110,000? It's not P directly. It is S. It is S which paid the 110. And remember, out of whatever operations that S does, our share P group is 80%. Is 80%. Is 80%. So in this case here, we paid 88. We paid 88. Now, ladies and gentlemen, remember, we never acquired this alone. We never acquired this thing alone. We have NCI. We have NCI. So could you kindly come and give us NCI? NCI, we either go the fair value way or the proportionate method. This examiner has told to us to use the proportionate. We use the proportionate method. Proportionate, like now for S, we know the NCI percentage was 20. So 20 of the net assets of S. 20 of the net assets of S. Net assets, remember, net assets of S. So what is 20% of, give me the NCI proportional. There is something I want to check out here. NCI proportion of the net assets. What do we have? Somebody there. NCI NCI, NCI. So should I take 20% of 140 or 20% of 270? 20% of 140 or 20% of 270? Somebody talk to me. Talk to me. Talk to me. Talk to me. Should I take 20% of 140 or 20% of 270? Awaniongeleshi. Remember, goodwill is computed as at acquisition date. As at acquisition. So this should be at acquisition, which is 140. So 20% of 140. So this should be 20% of 140, which will give me what figure? Somebody here. 20% of what? That is 28. 28. 28, 28, if I'm not wrong. And then we have 52%. 52% of SS at acquisition. 52% of SS at acquisition, that is 150. 150. So could you kindly give me this figure? Kindly give me this figure. Nikuonyeshe maneno sasa. So 52% of 150 gives me what figure at the end of the day? Somebody give me these figures. Najua nikirudia mara pili mtapenda sana this approach. This approach which I've shown to many students ikawasaidia sana. So ameniambia ni 70 what? 78. 78. So could you kindly give me these totals if you wish? You can get the total being the total consideration now. The total consideration, 120 plus 28 will give me what figure? And unfortunately, I have very few minutes left. So 120 plus 28 gives me what figure? Please just concentrate a little bit. I know this is something you'll come to thank me. So this gives me 148, eh? This gives me 148. How about this one, 88 plus 78? And 178, and 178, 178, 178. So from there, what do? You'll come under less net assets. You less net assets at acquisition. Less net assets at acquisition. Because goodwill, as we've said, goodwill, we normally evaluate goodwill at acquisition. Goodwill at acquisition. So the net assets of S at acquisition here, we have 140. And here we happen to be having what here? 100 and what here? 50 at acquisition. At acquisition. So could you kindly give me these answers? Then this automatically will give me goodwill. This automatically will give me goodwill. Goodwill, which will be equal to what here? Somebody for S. Is it not 8? 8. How about SS goodwill? SS goodwill. SS goodwill. So this is supposed to be 88 plus 78. What is 88 plus 78? Somebody must have misled me here. 88 plus 78 is 166. 166, thank you. 166. 166. So then this gives me 16. Ladies and gentlemen, remember this is goodwill at acquisition. If, for example, you were given the concept of impairment, I would have subtracted. But here there is nothing like impairment. There is nothing like impairment. So in this case here, the goodwill that we have at acquisition will be exactly equal to the goodwill at reporting. So therefore, the total goodwill will be 8 plus 16. The total goodwill will be 8 plus 16. 8 plus 16 equals what here? 20 what? 24. So in your balance sheet, where you are written goodwill working, please go and put 24 there. Go and put 24 there. In your balance sheet, go and put 24. In your balance sheet, go and put 24 there. Go and put 24 there. Great. Great. So that is a goodwill. Ladies and gentlemen, the moment you get goodwill, now straight away, go to retained earnings. Go to retained earnings. Retained earnings. Retained earnings is not even a working I normally do for consolidation. When I'm consolidating myself, I don't do retained earnings at all. I'll normally go to the balance sheet figure and get a balancing figure. Balance sheet, get a balancing figure. Get a balancing figure. Get a balancing figure. Now, ladies and gentlemen, listen. For you now here, that now that you are laying the foundation, it will be important for us to come and put down this goodwill figure. So, not goodwill, but retained earnings. So, group retained earnings. Group retained earnings. So, group retained earnings give us the P group retained earnings at reporting. The P group retained earnings at reporting from the balance sheet. From the balance sheet, what is the P group retained earnings figure? From the balance sheet, the P group retained earnings figure is 100 what year? 95. Is 195. Is 195. So P group retained earnings at reporting, we have 195, 195. And then now we have here share of post-acquisition profit. Share of post-acquisition profit for S. And then we have share of post-acquisition profit, SS. Remember, you already had these figures. You already have these figures. We already have these figures. So share of post-acquisition profit for S, if I remember, was it 26? No, 104. Please give me these figures as I disappear. I can see Mr. Njuguna here. So share of profit, post-acquisition profit S. Ilikuwa inakuja ngapi somebody? Who can give me this figure? Tulikuwa tumeshafanya already. 104. And then we have share of post-acquisition profit, SS. SS, I believe, was 31.2 for the group. For the group, 31.2. Uzuri hapa hatuna mambo ya impairment. Ingekuwa impairment of goodwill ungekuja unyorosha hapa. Right? Hapa hakuna mambo mengi, so come and give me the group's retained earnings. Group's retained earnings, nipatie figure. Group retained earnings, nipatie figure. Add hizi tatu. Add hizi tatu. Unipatie hiyo. Add hizo tatu nipatie hiyo jameni. Na hukuwa na fair value adjustment. Tulikuwa na fair value adjustments, all those depreciations would have lumped them here. And realized, for example, profits when we, so somebody is giving me 330.2. So could you kindly go to your group? Thank you very much. Please go to your group, retained earnings, kwa balance sheet yako ilikuwa umefanya kwa working 2. Enda hapa andika retained earnings 330.2. Andika 330.2. Andika 330.2. Andika 330.2. Andika 330.2. 330.2. Umeshaandika kweli? After that, now it's NCI. So NCI now should be the last one. NCI should be the last one. NCI should be the last one. So NCI should be the last one. So NCI, please give me NCI at acquisition. NCI at acquisition. NCI at acquisition. At acquisition ulikuwa ushafanya tayari NCI ile formula ya goodwill. Ile working ya goodwill. Ulikuwa na NCI at acquisition. Katika S, I think it was 28. If I'm not wrong. S was 28. How about at acquisition NCI? NCI here. 28 and 78. Thank you very much. 28 and 78. That is NCI at acquisition. NCI at acquisition. Give us post-acquisition. Post-acquisition profit. Post-acquisition profit. Yeah, S. Post-acquisition profit. Yeah, S. Yeah, S. Yeah, NCI. NCI in S. NCI in S. NCI in S. NCI in S. Post-acquisition. Tunamaliza. Post-acquisition profit NCI. Post-acquisition profit NCI. Inakuja namna gani? Post-acquisition profit NCI. Tuko nao kwa hii kona. Tuko tumegawa post-acquisition profits. 26. Thank you very much for S. How about for SS? How about for SS? 33.8. Now, ladies and gentlemen, remember this NCI. I wish ningekuwa na time kidogo, lakini time imekataa. Tuko na parent, tuko na S, na tuko na SS. Hapa kuna kitu moja lazima ujue sana. Ladies and gentlemen, remember when S was acquiring SS, it paid how much? It paid 110. It paid 110. S paid 110 to acquire SS. Ideally, This 110 should have been paid by P 80%, P wangelipa 88, na NCI wangelipa 22, NCI wangelipa 22, right? But you and I know for sure that the entire 110 amount was paid by who? By S. And the S is what here? S is our subsidiary. S is our, so it means that the parent basically paid the entire 110, meaning that as we are looking towards giving, NCI their share, we must remember that there is some money we paid for them. There is some money we paid for them, which we need to come and deduct here, 22. So in this case here, we have the investment paid by P group on behalf of the subsidiary, on behalf of NCI 22. So please come and give me these figures very fast. Give me the total, give me the total. The total we have 28, 26, and this 22 is subtract. This is something whenever we have this subsidiary, something that so many students forget. They end up giving NCI everything, forgetting that there is an amount that we paid for them. So Peter gives me 32 here. How about this one, SS? How about this one here, SS? What do we have here, somebody? 111.8. So please give me the total. Add the two. Give me the total. Add the two. Give me the total. Add the two. So when you add the two, what do we have? 143.8. 143.8. So please go to your NCI and put that figure there. Go to your NCI and then you put that figure there. And then you tell me whether your table is balancing. Give me the total assets. Give me the total equity and liabilities. This is how your balance sheet should look like. Like the tangible assets, 410. The goodwill, I hope we got goodwill of 24. Current assets of 210. Total giving us 644. Ordinary shares, 80, 330.2. Retained earnings, you can see. Non-controlling interest, we have 143.8. That is the figure we got, right? I hope everything is balancing. Is there somebody who has been able to really reach there? Is there somebody who has been able to reach there? Now, the only adjustments ambazo utafanya later, ni kama kuna intra-payables unazingoa like that. So otherwise, thank you very much. It has been a pleasure. I hope that method also can work for you. Is it a good method ama turudi kwa T? Is there somebody who has gained something? Iko sawa. It's a good one, yeah. Paka nirudie. Thank you very much. Tutarudia tena, don't worry. So asanteni, nasikia kuna class mko nao next. Asanteni.
I lost the thread there. Can you phrase it?
Okay, sawa. Thank you.